All right, ladies and gentlemen and ladies, today is another good day the Lord have made. As usual, we need to give gratitude to God, right? I was watching one video the other day. The guy said, you see, when you pray to God, even if you are asking of something, even if that thing is not yet there, no change yet in your circumstance, but make sure you start by giving gratitude to God. Because what you are praying for, God's faithfulness is always steady and is able to provide. You give Him thanks, gratitude first, and you know you're going to get what you are looking for. And if that thing is not forthcoming yet, perhaps God is delaying it, which is not a denial, to protect you. He knows the right time, what we call divine timing. He knows when to provide it for you, right? So when you wake up in the morning, before you touch your phone, before the noises of the world that are seeking your attention get you caught up, you first of all give gratitude to God for being able to wake up, right? Because so many people slept that couldn't wake up, right? We woke up this morning to be here. We don't deserve anything. We are not better than the people that couldn't make it today or make it up to today. So it's by the grace of God. So with that alone, we must say, thank you, Father. Right? Okay. And before we start again, I would like to commit this lesson into His hand. I would like to pray and ask Him to give us His wisdom. Because without His wisdom, there is nothing we can be able to understand. To direct us, to give us His guidance. And we pray. Then, now let's come to what we are here to do today. We're talking about funding requirement. Remember, we talked about funding requirement last time, right? If you can still remember what we did. Funding requirements, where we talked about different areas where you need finance to do your business, right? Because a business as it is, it doesn't just start running without the requisite finance for you to do the business. So if, first of all, you need finance to start a business, which we call startup capital, then once you are able to acquire that, you need finance again to run your business, right? That is what we refer to as working capital. As the name suggests, look at the name, starting capital for you to start a business, working capital for you to run your business, as well as growth capital. Do you understand what I mean? Now, let me unpack it much more for you to be able to understand. Okay, let me start with startup capital. What do you need startup capital for? For you to be able to buy perhaps the equipment that you need to start your business, to acquire things like what we call fixed assets that are required for you to operate your business. Without fixed assets, you are not going to be able to start your business, to operate your business. For example, if you have a business of making maguire cake, right? You need an oven, two of us, right? You need to buy pot, right? You need to buy perhaps a computer for you to be able to put in your inventories, to record your purchases, right? To prepare your invoices. Do you understand what I mean? So you need those stuff, right? For example, if your bakery, you producing products a lot that needs to be delivered, distributed to different areas. You need a delivery van, of course, right? So that delivery van, you need to look for money to buy it. So the money that you need to buy that delivery van can be classified as a startup capital. Does it make sense to you? Now let's talk about the working capital. Right. You need money to buy your raw materials. If you are manufacturing, like the example I gave just now, having a bakery, producing patisserie products, making cake, maguire, right? Then the donuts and all those type of stuff. Right. You need money to buy the raw materials. You need money to pay salaries, wages, if you got people working with you. You understand what I mean? You need money to put fear in that delivery van. So that one is the money that you need for you to be able to secure that is what we call working capital, right? So in most cases, the money or the items that you spend your working capital on are what you need to transform for you to be able to get the finished product, you sell the finished product to get back your money. Right. Whereas the one for startup capital, you use it to buy equipment and all those stuff that are not necessarily, although they are not usable or consumable for your business. Right. Then you need to buy them, and over the time it keeps on wearing out. We talk about depreciation, of which at the end of the depreciated period, you just need to dispose them of in form of asset disposal, of which you can be able to recoup a certain amount. We call it residual amount or residual value. Right? Don't worry about that. So then the growth capital is what you need perhaps for you to expand your business. It's for expansion, right? You've got a shop or you got your business that is making the like the Maguire business I've said, bread, cake, and all that. One of these days, you might require money to increase your production, right? And you don't have the money because based on your current production, it got is to a certain limit. Now you want to increase it. For example, let's say you got a new order, right? A new client, right? That require you to supply more than what you've been supplying before. So you need money now to increase your production, to increase your output. So the money is not going to be there. You must look for it. So that type of money, for example, if you go to the bank, now you say you need money. Okay, what are you using the money for? It's for expansion, right? The capital for expansion. So you can classify that type of money that will be needed at that point in time as the one for growth capital. Does it make sense to you? Now, having talked about the financial requirements, which we talk in terms of startup capital, right? Working capital. I hope I've reached on this stuff. Yeah. Working capital, then growth capital. Now you have to come back to your drawing board. Where am I going to get money to fulfill this requirement? Where? Right? You had a dream, right? Of owning a bakery. What? What type of business? A bakery. You had a dream of owning a bakery, right? Now, where am I going to get the money to for the startup capital first? Then the working capital, perhaps in future for the growth. Okay, let's first of all start with startup capital because you cannot talk about growth or working capital if you are not able to meet the requirement of a startup capital. Yeah. Mind you, you are on air. No? You are on air. Yeah, you can talk. Okay. Please, man, I think you can help me. Man. I'm looking for I said for new venture. New, okay, okay. I'm gonna talk to you later. Okay, no problem. Yeah. All right, guys. Now you've got a dream, right? Of owning a bakery one of these days. Right. Now you need to brainstorm. Right. The first point of departure is the startup capital. Where am I going to get this money? Do you understand what I mean? Yeah. Now you look for there are two ways that you can look at. We call it from your own side, right? We call that side equity, then or a borrowed capital, right? Am I going to the money that I'll be saving in my bank account? How much can I use? Or if I use that, how far can that go? Right? Then you can perhaps get money from your friends, right? Borrow money from your friends and their family. For example, you approach your dad and say, Dad, man, I want to start a business. What type of business? Bakery business. It's a good idea, son. But my problem is that, Dad, I don't have enough money, right? Then you tell your dad that you need the support. Then you get that from your dad to put in the business, it falls under equity, right? So, in other words, what I'm trying to say is, in terms of financing or financing option or funding option of a business, is classified into two categories. One, equity, the other one is borrowed capital. Right. Why do we call that one? Because this one, you need to pay interest. Here, perhaps you don't need to pay interest. Do you understand? You can say, okay, I lend you some money for a while. When the business is doing well, you bring it back the way it is. The way I gave it to you, no problem. Right. So you don't have so much headache. You know, headache or headache, how do you pronounce it? This one, you don't have so much headache because this one you don't need to pay interest on the borrowed capital. This one is not the one that if you don't pay, they choke you. You see, this one is dangerous. If you don't pay, they choke you. Because this one themselves, they are into business. Do you understand what I mean? This one is they are into business, right? If you don't pay them, they're gonna be after you. They will come and repossess your stuff, right? Okay. Now let's talk about the equity. Like I said, this one is your own money, or you take from friends and family from support. Then shares. Shares, for example, if you have these ones are for investors coming to invest in your business, right? These ones they will be prepared. The investors that will buy shares, they will be prepared for the business to generate money. From the money generated from the business, then they can be able to have what we call dividend, right? That you can pay out to them. They're gonna wait, right? But this one they can't wait for you. You understand? Because this one become part of your business. These ones are not part of your business. Anyhow you run your business is your problem. If you don't bring that money, you're gonna be in trouble. You see? But this one you share the same risk. They share the same risk with you. Whether if the business doesn't go well, they say they are in trouble. This one can never be in trouble with you. You are on your own. Right. So in the exam, they can ask you to give the two options of funding, right? You can say equity, then and borrowed capital. So when we talk about equity, these are the things that you need to consider, right? Own fund, they can ask you to give some examples, right? Then borrowed capital, right? Let me switch off. This is like this thing is making noise here. My student, I don't know what they are saying here. Right. So in terms of borrowed capital, we can talk about, okay, borrowed capital is divided into two forms, right? We have short-term loan. In short, borrowed capital, we are talking about loans, right? Loans, loans. For example, you can go to the bank, then you talk to the bank manager, I need money, right? Then the bank manager will say, what do you need it for? You say, no, I just need the money to buy my stock, to pay for my stock, right? So that one will be a short-term loan. The bank manager say, okay, what is going to happen is that let's check your account. We can give you a kind of overdraft facility, right? What do we call or what do we mean by an overdraft? Overdraft facility is accrued to a check account. If you don't have a check account, they can't give you overdraft. This is not a credit card. We are not talking about credit card here, right? Although credit card is for kind of a short-term loan if you got a credit card, but what we are talking about now is overdraft. Then, for example, the amount you needed or you need to pay for your stock is 10,000. Then you don't have 10,000 in your account. You got 8,000. Then the banks and say, okay, we're gonna help you with what we call bridging finance. Bridging finance. Bridging finance is a kind of a short-term loan. So we give you 2,000 rand or some in form of overdraft. So instead of you spending the 8,000 now, you are now allowed, if you apply for it, or if you've been granted that overdraft facility, then you can use the 10,000. Then you will be owing the bank in form of overdraft 2,000 rand, right? An overdraft facility normally has to be paid within a year, from 1 to 12 months. You need to pay off your overdraft, right? That is why, in the first place, we call it a short-term loan because it's a loan that you need to pay within a short period of time, right? Which in normal cases should not be more than 1 year. Does it make sense to you? Right. Okay, now there's another form of borrowed capital that can help you as well in your business. We call it trade credit. Trade credit. How trade credit works? Giving you stock on credit. Stock on credit. For example, you are setting up a bakery, right? Majority of the raw material you're gonna need is flour, right? You need to buy flour. Perhaps you don't have money to buy flour. Then you've seen a company that is selling flour. They can okay, we give you on credit. Then at the end of the month, then you pay back. You see, it can help you to start running your business, right? Because now the money that you needed for this one now will not be a problem to you again because you are getting it on credit. This is what we mean by trade credit, right? Or they can even, yeah, that is it's a form of borrowed capital. You need to pay back because it's not your money, it's not your stock. Once you sell your product, money you realize from selling your product, you must pay them back based on the terms of agreement. If it is something that you need to be paying them off instrumentally every end of the month, then you need to comply. Otherwise, if you don't pay back, they will choke you. Right? Okay, that is that. Then we got the one we call long-term loan. Right? A good example of long-term loan is a bond. A bond, bond for house. Right? If your business need the premises where to operate and you want to build the place, right? You don't have the money. You can go for a bond or a long-term loan for you to be able to build the place. Right? Like most of these factories you see around, They take this type of loan, long-term loan, to build the factories. You see? So they will go to the bank, then they will request for a long-term loan. They will ask, the bank will ask, what you gonna use it for? I say to build the factory. Then the bank look at the the business plan, of course. Then if they see that the business is viable, they can grant them a bond, right? And this bond normally takes up to about 20 years. 20 years. If you see any of your relatives that is paying off a bond, sometimes the bond is up to 20 years. They have to be paying it off instrumentally, right? You see, the funniest nature or the bad side or the downside, if you will, of this bond is that you have to pay what we call a balloon. They got what they call balloon payments. Inflated. They inflate it more than necessary, exaggerated. If you buy a house through a bond, if that house is 1 million, you end up paying almost 2 million. Did you see? So I don't encourage it, but because there's nothing you can do, you see, you buy because instead of you paying rent, it's better you take up a bond because that money gonna be paid towards reduction of your bond than pay rent. Because if you are paying rent, that thing doesn't. You are. It's like you are throwing your money in the sea. But if it is bond, it's gonna be offsetting the bond gradually. At least one day, it's gonna be yours. Because there are certain people they be paying rent for more than 20 years, and at the end of the day, the house is not theirs. You see? And if you mess up, every time the landlord will be coming to you to increase the amount. Every year they put a certain increase. And once you finish paying the bond, they kick you out. But if you have yours, it becomes yours. So that is the good side of it, the good news about it. Do you understand? Car is the same thing, right? Car is a type of medium loan, right? But here you can classify it as a long-term loan. It's the same because these days now, cars can have a payment period of 6 years. Because I could see now that you got some that are 72 months. 72 months. Yes, balloon, they got balloon payment. They got balloon payment. Because a car that is 500,000 now, at the end of the day, you end up paying 1 point something million. So if you got the money to pay cash, you pay that 500,000. You see what I mean? So because they are putting and one thing I don't like about it is this. When you are paying them off, you see, there's what we call principal and interest. That interest is the balloon payment, which is always higher than the principal. So whatever amount you are paying as an installment payment, they make sure that 90% of it goes to the interest. Then they use a small amount to offset the principal. So let's say you bought a car, right? And the period is for 72 months, which is 6 years. Then they said you must be paying off the car maybe 10,000 rand every month, right? Okay. 10,000 rand car is about, let's say, a car of Toyota Hilux. You know Toyota Hilux? Yeah, it's gonna even be installment. They're gonna be more than 10,000, right? Let's say 15,000. And Toyota Hilux now these days is gonna be around 800 or something thousand. Or let's say, huh? Okay. So when you calculate the amount you are paying every month times 72 months, you're gonna hold your head like this. You see? But another thing I don't like about that is this. Look at how it works. If it is that 11,000 you said, right? 10,000 rand will go for the interest. Then that 1,000 rand will go for the principal. Let's say you bought it at 800,000. So every month you pay them 11,000. They will use that 10,000 to reduce the interest. Then the principal, they will just reduce it by 1,000. You see? So when you've paid now up to for 5 years, When you see the balance, you will see that every month now is 1,000 rand that is being removed from your principal. So 1,000 times 12, 12,000 times 5, 60,000. Then 60,000 minus 800,000. You will still be owing up to 700 and something thousand. After 4 years, 5 years, you're gonna hold your head like this. Because the money, you see, these people are Shylock. You know what I mean by Shylock? You know, a Shylock that demanded a pound of flesh, right? The government must intervene. This thing is the credit bureau, the way they are working here is not good. Because let's say you pay that amount after 5 years, perhaps something happens to you. You are unable to start continue with the payment. You know what they're gonna do? They will come and repossess the car. You see, you paid more than 500,000. They will come, they will undermine that. They will come and take the car from you. Is that thing good? Yeah. Huh? But if they upgrade your car, yeah, if you are in a good standing, yeah, they will upgrade it for you if you are in a good standing. But if you are not in a good standing, you are in default. They're not going to upgrade it for you. Did you see? So those are the ironies, right? But what can you do? But another thing is, if you are using it for business, it's not a problem, right? Because obviously you are going to generate money. From the money being generated from the business, you can be able to keep up with the payment, right? But if you are buying that Toyota Hilux because you got a small job, a teacher in somewhere in one of the primary school, and the salary you are earning is not even a lot to keep you, then you pay that amount for Toyota Hilux. And once you default, then they will come and repossess it. That means you made a stupid decision, right? So before you embark on this route, you must make sure that it's for business. Of course, what we are talking about here is business. Don't buy something on credit for your own personal use, of which there is no money for you to keep up with the installment payment. It's dangerous. Right? Okay. Did I explain this? Shares. How does shares work? Right? Shares, like I said, if you are operating a one man's business, you cannot raise money for your business through shares, right? If it is partnership, you cannot raise because you can as well ask your partner to look for money, right? But if it is a PTY company that are allowed, you can issue out shares, whereby the shareholders, those are the ones that are gonna invest, buy the shares. The one that are gonna buy the shares we eventually become shareholders. That means they are part of the ownership of your business, right? So then, when you start running the business, at the end of the year, you declare profit that is being made. Then from that profit, you can be able to declare a certain amount that needs to be paid to the shareholder in a way of dividend. That is how this one works, right? Okay. Any question? So far, so good. So this aspect is very important. This is what we call financial management at university level. They call it financial management. And in business, practically is financial management. Because if you are you running a business, you don't know how to manage this thing properly, right? It's gonna have a problem. Your business will have a problem. I will give you an example, now, right? That this thing is very important for you to know how to manage as a form of financial management. Let's say that you need money for growth of your business, right? You need to expand your factory. What type of loan here are you going to go for? You're not going to go for short term loan. You see, it's the period over. Yeah, long term. You must go for long term. There is what we call matching maturity. Matching maturity. Here, you know it's gonna take you long time for you to be able to recoup your money. You don't go and take overdraft. Because overdraft, if you don't pay, the interest rate here is very high. If I haven't said it, the interest rate here, yes, that is very interesting aspect I need to tell you as well here. The interest rate for short-term loan is very high. I think these days now, if I'm not mistaken, it's 24%. Very high. You see, the interest rate for long-term loan is low, right? For example, for a bond, you can still be having something like 10% or 8%, right? I remember when I started my bond, it was about, you can even negotiate it. This one, you can negotiate. I started with, was it 8%? Then they told me that I must come and open an account with them, my salary, my account. That if I do that, they're going to give me a few percentage. They bring it down a little bit. Then I started, then I went to open an account with the Standard Bank. They gave me this bond, approved it for me. I didn't even have an account with them. You see? So then I opened an account, then it became low. So this one is not high, but this one is very high. It's the same thing when you buy something on credit, clothes or whatever. This is what they charge. Is this short-term loan? 24% is very high, right? Yeah. So you need to know how to manage this. Yeah. Any question? Huh? 3 minutes. Okay. So using financial institutions, right? So this you can get money from the banks. This from okay. When we are talking about financial institution, we got banks, right, and other institutions where you can get money. In short, to finance your business. That is what we are trying to say here now. So banks they offer this type of facilities, current account, right, which is a check account, savings account, then internet banking, telephone. These are what is associated with mostly with the banks, telephone banking, auto banking, right? Then you got other institutions where you can be able to uh, acquire your funding or look for your funding to fund your business. Then you got cooler, right? Cooler enterprises. Then you got business partners, right? So what we are trying to say is if you have a business and you are in a situation that you are looking for ways to finance your business, right? Besides approaching the bank, because the requirement of the bank is very stringent. It's not so easy because you need to meet certain threshold, certain requirement before the bank can look at your face, right? So by virtue of that, the government decided to set up some other. Some of these things, some here are being sponsored by the government, like Hula, right, and some other private organizations, right? So to open up more opportunities for those people that wouldn't be able to qualify in getting money loans from the banks. So this is another pathway, another avenue that can be exploited. Cooler, this ones you can Google it. Business partners, I've been to this, I know this one very well. Next time I will tell you my encounter with this one. Business partners. Then they got micro lenders as well that lend to enterprises, entrepreneurs, when they say micro, not so much money. They got chambers of commerce. These chambers of commerce doesn't necessarily lend money, but it can give you certain advice and you know and a situation whereby you can be able to meet as well with other members, same members in the same industries where you are operating, right? Although you not be able to get finance from here, but information is capital, it's a resource as well. That can, yeah, information is a resource that can help you in running your business, right? So you said the period is finished. Okay. So next time we're gonna continue from here, right? You know how to switch off the video.